Good morning, my YouTube friends. Well, today I'm going to talk about the basics of options and options trading. I'll get into a couple of strategies if I have but I'm really going to go into the basics and explain it a bit for you guys. I've been asked from a few people to talk about it, so that's what we're going to discuss today. Well, good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is Wednesday, January 24th. I hope you're all doing well here in sunny Las Vegas. Well, maybe not so sunny today. I'm excited to see Tesla's earnings today, but before I get into that and before we start talking about options trading, and really before I forget, because if I don't talk about it right in the beginning, my brain goes all over the place and I tend to forget things. If you guys could do me a favor and hit that subscribe button, smash the like button, I'd really appreciate the support. It goes a long way. It helps YouTube's algorithm, which I know you hear in everybody's video, helps other people find the channel. And again, I'm super excited to have seen how we're growing. It's been really cool. So thank you guys. But that really goes a long way, and I appreciate the help. So let's talk about options a bit. And I'm going to start out with the basics of what goes into an option. So there's two different types of options, which I think you guys are probably all aware of, which are calls and puts. There's two things basically that comprise the option. There's the strike price and there's the date of expiration. The strike price is the price that the stock has to be above or below to activate the option, depending on whether it's a call or a put. And then the date of expiration is just like it sounds, the date when the option would expire. People think of calls as a bet that the stock price is going higher and a put as a bet that the stock price is going lower. But really, depending on which side of the transaction you take, they're both kind of the same thing, and one can be a bet to the upside and and a bet to the downside. Like if you sell a call, in some people's brains, you'd be making a bet to the downside. But that's not necessarily true because an option is comprised of a lot of different things inside of it. Um, the main thing that you get out of it that you're not getting in a stock is the time decay, because based on the expiration date, the option's going to lose a little bit of value every day because of that, what's called time decay, or in the Greek terms, they call it theta for those of you who know a little bit more about the options. The price of the option, also known as the premium, is based on the how much time is left, so the time decay, the strike price, and then the volatility of the underlying equity. The more a stock moves, the higher the premium is going to be because it means the more likelihood that that strike price actually gets executed over the time frame of the option. For the most part, it really is just a mathematical formulation. And at this point, the traders are done by computers that have a real good knowledge of how much the stock moves up or down on a given day to figure out the volatility of the underlying equity. And the options should be pretty fairly priced depending on the equity and if they have a lot of volume. Now, if you find a stock or you're looking at options on something that has very little trading, it's not going to necessarily be priced fairly, because I want you to think about something. If you look at an options price and it's got a $1 bid at $1.20, and of course I'm just making it up because I haven't even picked the stock. But if it's not a heavily traded stock and you look at it and it's got a bid of $1 and an offer of $1.20, well, that's a 20% spread between the bid and the offer. Even though it just looks like 20 cents, it really is a ton of money as a percentage, and I would be really careful on things like that. Now, keep in mind, this is not financial advice. I am not giving you any things like you shouldn't use the information am sharing to make any financial decisions. You guys need to do your own research and maybe even consider talking to a financial planner. But let's talk about the options a bit so we understand how they work. The two primary ways that I use options is I'll sell covered calls and I'll also sell what I would call covered puts. A covered put is having enough cash in your account to buy the underlying equity if you get exercised on that put. Now, remember I said originally a put is sometimes thought of as a bet to the downside. Well, if you sell a put, you're promising to buy that underlying equity if the stock falls below the strike price on the expiration date. So I'll use an example of Target just because I know where it's trading. But really, it's not financial advice because I don't have an opinion on Target right now. But I know it was trading around $140 earlier in the day. I didn't look up the price of the stock options. They will change in terms of how much premium they get if earnings are coming out sometime soon, because sometimes that'll cause a little bit more volatility in a stock and give it a little bit more premium. So if you're watching a specific underlying stock and you notice that out of the blue, all of a sudden it's getting a better price for the options, pay attention to when the earnings are because that might be the only reason as to why. Anyway, back to the example. So target's around $140. If I look out to the March 15 puts and I want to sell the 135 put, maybe I could get $2 for that put. If on March 15th Target is trading below $135 and I've sold that put, I am committing to buying 100 shares of Target at $135. Now that's the case even if Target is down at 100 or 90 or 80. So you do have that risk of if the stock really falls a good amount, you're still committed to picking up the stock at $135 or whatever the strike price is for whatever underlying equity you're looking at. Now, you do get to keep the premium for selling the option no matter what. That's where the other people who are telling how to do it are saying it's just guaranteed money. So now, since I said it was around $2, I get to keep the $200 no matter what. So if Target drifts higher at March 15th and we see it's at $145, I still keep my 200 bucks. If it drops lower but it's still above 135, same thing. So come March 15th, if it's trading 136, 137, I get to keep the $200. Nothing else happens, life moves on. The only time I have to make a decision from there is if the stock's below 135 and I get what's called assigned, the 100 shares I'm guaranteeing by selling the put. Now, of course, the intention of options for some people is to use it as insurance. And you could be the person buying the put if you own 100 shares and you just want to make sure it doesn't go below 135 for the next month or so for whatever reason that you have in mind. The reason I like selling options and the reason I implement these strategies is I look at options as kind of like insurance. And I do feel like you get a little bit more by selling insurance instead of buying insurance. I feel like the people who buy calls and who buy puts are kind of making bets, and I would rather be the casino that's taking the risk of the people who are placing those bets. Now, again, it's all gone so computerized and it's also perfectly priced. I wouldn't expect to make zillions of dollars on these strategies anymore. When it used to trade on the floor and you had traders who were using their sheets and going to the Black-Scholes model and plugging it into a computer and then standing on the floor all day making markets, I think there was a better opportunity. But the way things have progressed, essentially the big companies have squeezed out the local traders and then they've widened out the spreads of the options markets now that they've gotten rid of everybody and you're pretty much trading against a computer. That doesn't mean I don't still like these strategies because I do. Now, when I'll talk about an example for a covered call strategy, but keep in mind, for the most part, I do really long-term calls, covered call strategies for my own accounts. I tend to stay away from the short-term ones because I do feel like the computers have a bit of an advantage. And when I look at the long-term ones, I'm doing it because if the stock goes that far, I'm happy to sell my stock and I feel like I collect extra dividends on some of my stocks. Target is one of them. I sold next January's 210 call, and I also sold a 200 call because when I was buying it at 115 and below, my thought was if the stock goes up $100, I've made almost 50% on the stock. And if I can get an extra $100 over a year, kind of like collecting an extra dividend, well, I'm happy to sell it at that price. That's good return and I get an extra dividend instead of four dividends. But back to what I'm explaining in terms of the shorter term trades. Same thing though in terms of a call option. It's kind of a bet to the upside. So same example, targets around 140. If you look at the March $145 calls, again, this is a guess. I really haven't looked. Maybe it's worth about $2 for the call. If you own 100 shares of the stock and you're happy to sell it at 145 by March 15th, well, you can sell a call against it and maybe you get $2. And same thing, you would get to keep that money no matter what. If the stock is above $145 come March 15th when the options expires, well, you're committing to selling those 100 shares at $145. Doing both of those things is kind of what people are referring to as the wheel strategy. They sell an $135 put. If they get filled on the stock and now they're assigned 100 shares, they might turn around and sell an 140 or an $145 call for a month later. It's a good strategy. The thing to be careful about is markets don't work that perfectly, and you really have to do it with stocks that you're comfortable owning because it's really nice if it would fall to 134 and you get filled and you're able to sell the 145 call and the stock just dramatically goes higher $10 and wow, you get filled. But that's typically not how things work, and you have to adjust accordingly and decide what makes sense. I do use these strategies as well. I just say that so to tell you to be really careful because a lot of the people who are talking about these things make it sound like it's such a simple transaction. It's so easy. You just do this and it's free money. It is so not the case. More times than not, stocks tend to drift in the same direction for a long time. So if you sell the put, you could get assigned and the stock could continue to go lower. And if it isn't something you were really committed to owning, as it continued to go lower, you're going to get stressed and it could cause problems. The other thing is the less volatile a stock is, the less premium you're going to get for it. So the math may not make sense to you to pick up some extra money to sell a call for whatever underlying equity is. I mean, if you look something like Pfizer that I've talked about that I like as an investment, it doesn't move very much. So if you start to look at their options, unless it's when earnings are coming out, you're really not going to get a lot of money to trade the options, and Pfizer's trading around $28 and change. I mean, I don't know, a month out call, if earnings aren't going to come out, you might get 20 cents. And while that's 1% of the stock, I just don't know that it's worth getting taken on a selling covered calls when I want to own the stock. It just isn't for a lot of companies. I also like to be in the position that I have enough money that I like to do what I think of, and somebody else referred it to this, so it might be an official name, but what's called a covered strangle. If I can own 100 shares and still be in the position to sell one put at a strike price where I might get assigned another 100 shares, as well as sell my one call, so that I'm getting that time decay no matter which direction the stock goes, and either I get assigned another 100 shares of the stock or I have to sell the 100 that I have. I like doing those trades because I think I am picking up all the options bulk, like the value of it, no matter which direction the stock goes. Now, again, you have to be in the right financial position to be able to own 100 shares, be able to short the put so you have enough capital to buy another 100 shares. And if the stock goes higher, you're okay selling it. Now, you can always look to less expensive stocks. I tend to do this with Rivian. I do use the wheel strategy with it, and it's got enough volatility in the stock that I feel like there's enough premium in the options to make it worth it. I also tend to do it with SoFi. They're both rather inexpensive stocks, but keep in mind picking up 10 or 15 cents as a percentage to the value of the stock is actually a decent return for those companies because the price of the stock is so little. They're also both two companies that I don't mind getting assigned shares because I like the companies. So if I own a little bit of Rivian and if I own some SoFi, I'm totally fine with that. But I also like the volatility value of them. So I feel like it's worth selling the options. Now, what I do, again, not financial advice, you have to make sure to do what you guys make sense for you. In a company like SoFi that I want to actually own, I take some of it and I put it in the safe deposit box, just like I do my Amazon and Google and the things I talked about in that video. But I then take a small amount and I might sell two puts, which I did today because next week they have their earnings coming out and it's getting a nice dividend. It's getting a nice premium for it. If I remember correctly, I think I sold the $7 put today. I sold two of them. And I think I sold three of them and I think I got about $35. So I got around $100 to sell three puts. Now, if I get assigned, I need the $2,100 to be able to buy those 300 shares. And if I do, I'll then consider looking to sell calls around $7.50 or $8 and see what that pays. But it'll be after the earnings, since I did it for after the earnings. So I'm guessing the volatility will be less and I won't be able to get quite as much to do that. But that's why you have to pay attention to when earnings are coming out and a little bit more. The other thing is, I'll repeat again, be really careful. Expensive options have a reason. These computer programs are really intricate, down to everything you could ever come up with. So, really, just be careful with options. It's not free money, but it is a good strategy to be able to get a little bit extra than just owning a stock potentially. And I enjoy doing it. I like that it adds a whole new dynamic to stocks and it helps you have a better understanding of their movements and the ups and downs and things like that. Now, I'll go back to what I was saying that really how I use options or at least covered calls on the stocks that I own for a little bit longer term. So when I bought Target, I then sold the 200 call and 210 call for next January. The reason I did that is it gave me over a year of owning the stock. My thought process is that's long-term capital gains. So I'm not worried about short-term gains and having higher taxes. Now you have to check with your accountant for what works for you. Also, the stock would be up such a big percentage that I'm happy to take that as a trade and not be owning the stock anymore. And then I get the extra premium for selling the options. Now, I didn't do this with every share of Target that I have because at least where it is now, I like the company and I like the valuation, so I thought it was a good purchase. And I don't mind owning Target for the next 5 or 10 years. So if I buy 300 or 400 shares, which is a rather large position, and sell two options and get an extra $200, while that doesn't sound like a lot of money, it adds up. If you can squeak an extra percent or two out of everything that you do, that's a big difference. I mean, the difference between getting 9% return and 11% return over 10, 20 years is immense. And that's why I look to sell the options. I'm not looking to make $1 million. I know I did a video on how to make $10,000 a month doing options. And I'm happy to do more of those because I know it had good viewership and people find it interesting. And I'm happy to show people the math of how to do it. But I also wouldn't rely on that. The industry's changed so much. Like when I was a floor trader, there was such a big advantage to being on the floor. That's where the value is. Now that it's gone computerized, I think it's really changed the industry that it's very hard to be able to do it day in and day out and make a living the same way. And the real advantage of the floor, so now I traded currency options, or currency futures. My brother traded stock options. The advantage, especially in the beginning, was when they traded in eighths and not pennies, because an eighth is 12 cents wide or 12 and a half cents wide. And when you're trading a stock that's, pretty well traded, if you go look at Amazon options, they're a penny wide, 2 penny wide. Well, back then, the smallest was a 16th, which is 6.25 cents, and possibly an eighth, which is 12.5 cents. Huge advantage. Anyway, when I was trading currency futures, the real advantage was knowing who's who on the floor. So I know that Bryce works for Morgan Stanley, and I know that Mike works for Smith Barney, and I know that Teddy works with, PRMG, and I know where all the banks are. Well, they're on direct headsets with their traders in New York, and every day, multiple times a day, all of them start doing the same thing. If I'm paying attention to the different people in the pit and I'm watching those guys and they all start doing the same thing, really all I had to do was copy them and start, if they're buying, start buying, and if they're selling, start selling. And we were in and out of trades so quickly, it was a big advantage. That's the real advantage to the floor. And now that it's on computers, you can't see who's who. It's just numbers. You don't know who's the bid and who's the offer and which one's the customer and which one's the bank, and you can't really see when they're all doing the same thing. So it really changes the market, and you really have to have a much longer term outlook and be able to deal with the ups and downs a lot differently. On the floor, I might be able to sell something for 2 cents and sell it for five a minute later or under a minute. It's so much different. And from trading on the computer screens, I don't do that anymore. Anyway, I hope that explains stock options. Feel free to ask more questions or specifics about them, and I'll get into some other strategies. I'll get into the wheel a little bit more if people want, and I'll also talk about how to make money on a monthly basis and how to use these strategies. And we can look at some specific stocks if you want. So have a great rest of your Wednesday. Excited to see how Tesla's looking around 1 o'clock and what the earnings come out like. Stock's been struggling for a bit. Me personally, I'm hoping to see what they sell as bad information and the stock goes higher. I always say it's best to have, the opposite happen with the stock of the information coming out, because that tells you a lot more about the direction of what's going on. Again, have a great Wednesday. Hit that subscribe button, hit the like button, and comment. Let me know what you guys think.